Understanding IRS Rule 72T and 4 Critical Aspects You Need to Know. Hello. If you are looking to use retirement funds early, then this discussion is for you. Today, I want to discuss IRS Rule 72T, which allows penalty free early withdrawals from retirement accounts before age 59 and a half. While this rule can be a financial lifeline for those who need early access to their retirement funds, it comes with strict requirements that you must understand before proceeding. I'll focus on four critical aspects that often catch people by surprise. To start, fixed amount withdrawals. Use complex formulas. First, let's talk about how your withdrawal amount is calculated. Unlike regular IRA withdrawals, where you can take out whatever you need, Rule 72 TR requires you to withdraw a fixed amount each year, calculated using IRS approved formulas. There are three calculation methods: required minimum distribution, RMD method. This recalculates annually based on your account balance and life expectancy. It's the most flexible, but typically provides the smallest withdrawal amount. Fixed amortization method. This treats your account like a mortgage, spreading it over your life expectancy at a reasonable interest rate. You get the same amount every year. Fixed annuitization method. This uses annuity factors from mortality tables to determine your annual payment. Like amortization, it provides a consistent annual amount. The key takeaway: you don't get to simply decide how much you need. The IRS formulas decide for you based on your account balance, age, and current interest rates. These calculations can be complex, and most people need professional help to get them right. Secondly, withdrawal amounts are capped very low. Here's where many people get disappointed. The withdrawal amounts under Rule 72T are typically much lower than most people expect or need. Why? Because the IRS calculations are designed to make your retirement savings last for your entire life expectancy. If you're 45 years old with a $500,000 IRA, you might expect to withdraw $50,000 or $100,000 annually. In reality, depending on the method used and current interest rates, you might only be allowed to withdraw $15,000 to $25,000 per year. The younger you are when you start, the lower your annual withdrawal will be, because the IRS is spreading that money over more years. The formula assumes you'll live into your 80s or 90s, so it rations accordingly. This limitation makes Rule 72 T unsuitable for people who need substantial cash flow from their retirement accounts. It's designed for modest supplemental income, not for replacing a full salary. If you're considering this option because you lost your job or have major expenses, you may find the withdrawal amounts inadequate for your actual needs. Then there is allowed absolutely no changes to the account once started. This is perhaps the most restrictive aspect. Once you begin 72T withdrawals, you cannot make any changes to that IRA account. And I mean virtually any changes. You cannot add new contributions to the account, roll over funds into or out of the account, nor change investments in a way that reduces the account balance below what's needed for the calculation. Also, you cannot take out extra money beyond your calculated amount, skip a year's withdrawal, nor combine this IRA with another IRA. The account essentially becomes frozen in its purpose. Many people don't realize that even seemingly innocent actions can trigger what's called a modification of your SEPP, substantially equal periodic payments. If you modify the plan in any way, the IRS will retroactively apply the 10% early withdrawal penalty to all previous distributions, plus interest. This means if you're 3 years into your 72T plan and accidentally contribute to that IRA or miss a withdrawal, you'll suddenly owe penalties on 3 years' worth of distributions. That's a costly mistake. The practical impact: you need to set this account aside mentally and administratively. Many people actually establish a separate IRA just for their 72T withdrawals, leaving their other retirement accounts untouched and flexible. Lastly, this is a one-time decision. Finally, understand that Rule 72T can only be implemented once per IRA account. You can't start it, stop it, and restart it later. Once you begin, you must continue until the later of 5 years from the start date or when you turn age 59 and a half. Whichever comes later is your commitment period. If you start at age 45, you're locked in for nearly 15 years. If you start at age 58, you're locked in for 5 years minimum. There's no pause button, no off ramp if your circumstances improve, and no do overs if you realize it's not working for you. This makes the initial decision incredibly important. You need to be certain about your long term financial needs, your ability to live on the calculated amount, and your commitment to following the rules precisely for years to come. Therefore, Rule 72T is a powerful tool for those who truly need early access to retirement funds, but it's not a decision to make lightly. The fixed calculations, low withdrawal caps, absolute prohibition on changes, and one time only nature make this an inflexible arrangement that demands careful planning. Before proceeding, consult with both a tax professional and a financial advisor who have specific experience with 72T distributions. The penalties for getting it wrong are severe, and the commitment is measured in years, not months.